A little bit about myself. Actually, did a good job there. I've been trading the markets a little over 25 years. Just a quick bio. My father went to the School of Hard Knocks, and he had two sons. One of them learned about the markets, regardless of what fields we went into. And so he actually took it upon himself to teach us about the markets. He made us read all kinds of stuff out of magazines, newspapers, anything he could get his grubby hands on. He had a stockbroker. His name was Tom Busby. And he asked Tom to help him teach us how to trade at the ripe old age of 17 years old. And so we went off to an investor boot camp here and there. And when we got back, he sat us both down, wrote us each out a check for $10,000, put it in a stock account, told us we could make money with it or not, but he didn't never give us another dime. And he stuck to his word. I went off and got a couple of degrees in engineering, was a pipeline engineer for about 10 years. Tom Busby started a school in Mobile, Alabama in 1996, and by 2000 they had put me up in management, and by that time the market had really become a hobby of mine. I was waking up at 3 o'clock in the morning, trading the index futures up until about 6:30, going to work all day, coming back, and finally I guess he caught me on a bad day. I was just a big old babysitter by that time, and said, come down and help me teach people how to trade. And so I got to think, how many people get to teach their hobby. And so I moved to Mobile, Alabama in 2000 and been teaching and trading ever since. I've traded in, I don't know, every kind of market you can probably think of. Have not traded every vehicle by any means, but I enjoy trading. It's a lot of fun. It can beat you up sometimes, but besides that, it's really, really really neat. I myself prefer commodities. I like to trade things that we use every day. So that's one thing that I probably trade most of, but I love trading stocks and equity options and things of that sort. So anyway, there it is. Tom, just very quickly, I guess my mentor, is really a pioneer in electronic trading. He actually had one of the first Globex terminals, which what we used to trade through when I was in school and stuff like that. But it was tied directly into the CME, but he is a member of the CME, and I don't know if you can say he was a member of the CBOT also, but the CME bought him, so there it was. He is I guess, a lawyer by degree, but he also was a captain in the Air Force as well. So he is, of course, retired from that. But the two of us, between the two of us, we probably have about 55, 60 years of experience, and well, trading's a lot of fun. Of course, there is risk in trading, and I am not the best typist in the world. I guess that's the engineer in me. So if you see a typo or something like that, let me know, and I will get it corrected the best I can and start going from there. But of course, you should not trade with money that you cannot just lose and ruin your lifestyle with. You need to have some risk capital. You cannot win 100% of the time. There's nobody out there who can, and anybody who says they can, run from them as fast as possible. But we do have losses, and we do have to kind of be wary of that. Of course, we always like the gain side of things. They always say past performance is not indicative of future results, which at times is a good thing, because you don't want to lose all the time. But at other times, it's too bad, because you always like to keep the good trades going. So, but anyway, just so everybody knows that there's risk in trading, we shall move on. One thing that I focus on is the S&P, and I want to kind of backtrack just a little bit here and start kind of going from the bottom up. The S&P 500 cash index is an index, of course, created by Standard & Poor's. You also have the Dow 30. It used to be the Dow Industrial Average, but now it's the Dow 30 index. A lot of people have heard of the NASDAQ composite, which I don't know why they quote that thing, just because, well, why don't they quote the New York composite also? Yet everybody thinks that when you hear the Dow was up, that all the stocks were up. Well, you're only gauging 30 stocks, so that's not necessarily true either. But so we watch the S&P 500 just because it's the big dog. All the money managers and everything like that gauge themselves by did they outperform the S&P or not. But when we start looking at the S&P, basically it's the Fortune 500 companies, the big companies that are out there, and odds are if that index is higher, about 70–75% of all stock has gone up also. Now you are going to have some stocks that go down just because of no corporate news or whatever it may be, but usually you will see most stocks move up. Of course, an index is made up of stocks, and of course an index can't move unless the stocks inside of the index move. The problem is with the S&P 500 cash index is that it begins, and I do everything in Central Time, so I apologize for that. Right now it's 5:40 Central p.m. Central Time, so if you're in the world or in the United States, that's what I'm going to kind of be using here. This is just the Central Time area. But we start out at 8:30 in the morning Central Time. And the cash index closes out at 3 p.m. Central Time, or 9:30 Eastern to 4 p.m. Eastern. And if you think about a 24-hour market, right now we are going to be, in 20 minutes, the Japan market's going to open. You're going to have Hong Kong opening up in about an hour and a half. You got New Zealand already open. So across the international date line, tomorrow has already started trading. And so we actually look at a 24-hour market. But if you look at a cash index, it's only around for 6.5 hours in a day. And you probably heard on CNBC or Bloomberg or whatever it is that, the futures are pointing to a higher open, or we're 6 points below fair value. Well, what they're looking at are the index futures, which is a derivative of the cash index, just like options on the S&P or the SPY, the spider, is a derivative of the cash index. It's trying to represent the cash index. So I like to see something that moves around with the world because they trade our stocks around the world. I mean, think about it. You can buy Toyota Motors here. You can buy Siemens, Nike. I guess that one is kind of local anyway. But you look at Adidas or something like that. These are all foreign companies. Potash, traded on our exchanges. We have a new one here not too long ago, Alibaba, right? That's a Chinese company. So they trade our stocks around the world also. I mean, you can wake up early in the morning and turn on Bloomberg and watch our stocks trading in Europe at that time. Well, our cash index isn't moving, but our stocks are. So I'm wanting to see what our stocks are doing around the world, and hence I watch the index futures. So when we start watching the market, it's not just between 8:30 and 3 o'clock in the afternoon. It's almost 24 hours a day. Now, we can't stay up that long. We do have to sleep and stuff like that and spend time with the family. But the thing is we get a feel for what is going on around the world with our stocks. We can wake up in the morning, the market might be down, but that doesn't mean it stays down. So we actually have to start dividing things out between who's in control of the market. Let me kind of move on here. But here's the big stocks that are out there. Everybody loves Apple. But you got GE. It used to be how GE goes is how the economy goes, and I think people are kind of blown off GE anymore. But you got the Googles and the Microsofts, and of course people watching Exxon or Chevron or whatever, they've been getting hit pretty hard just because the price of crude oil is down pretty good. Procter & Gamble, Kimberly-Clark, the big old staples that are out there. But these are companies that have been around for quite some time or are quite large, just depending on how you want to look at it, because Google hadn't been around that long. Apple has been around about as long as Microsoft, but that's only been about 30 years. Pardon me. As opposed to someone like GE, who's been around since dirt began and stuff like that. So we want to see how these stocks start to move our indexes, because they're all in like the S&P 500 or the Dow 30 or the NASDAQ 100 index. So when we start looking at how these stocks begin to move around, all of them kind of have their own little seasonalities. And we can kind of take advantage of those seasonalities, not only in the holiday season, but actually throughout the year as well. So let's kind of look at the global market very quickly. When we start looking at our method here at DTI, we have three main elements. One of them is time of day. That's what I was just about to get into. Another one is key numbers, which is support and resistance. Other one is indicators, but depending on the time of day, we might have a different indicator, because you can't look at the New York Stock Exchange tick at 6 o'clock in the evening, right? So we have to look at different indicators depending on what time of day it is. You don't have to trade in the evening. You don't have to trade earlier in the morning. But a lot of people work during the day. And it might be easier for them to trade early in the morning, go to work all day, spend the evening off, and kind of go from there. It all depends on somebody's own little schedule, if you will. So let's talk about time very quickly. we have a 24-hour market. As I just stated, Asia is opening up. It is tomorrow there. So we're looking at tomorrow's market today. That's pretty cool. We got to get to see into the future, right? But we start out at 5 p.m. Central Time. Again, these are all in Central Time, so be aware of that. We start out at 5 p.m. Central Time, which is about 45 minutes ago, and this time segment goes up until 3:30 in the morning. Now, Europe, the European cash markets, their stock exchanges and stuff like that in Europe actually open up at 2 a.m. The thing is, they have a lot of economic news that comes out between 3 and 4 in the morning. If you think about economic news, everybody wants to know what the economic news is doing. So it's market food, right? So if you have good market food, market goes up. Bad market food, the market goes down. So we want to see how their news reacts. Is it going to drive the market higher, or is it going to drive the market lower? So that's why we start that time segment, that second time segment at 3:30 in the morning, just because we want to get past their economic news. Now, of course, at 8:30 in the morning, again, Central Time, we start our morning market here. Now, what's really cool about our first 2 hours of our market is Europe is still open and trading. So our first 2 hours of our market has the most liquidity and usually the most volume, unless there's some news that comes out in the afternoon, like the Fed or something like that. Then we'll see the rest of the day here in the United States. So we want to see how that first 2 hours works. Is it pushing higher very strongly? Is it pushing lower very strongly? You look at today, they just couldn't seem to go up. The ECB, that's the European Central Bank, they're Fed in Europe. And their Fed chairman, Draghi, came out and kind of said some words, and it sold the market off pretty hard about 7 o'clock this morning. The market really couldn't recover from that the rest of the day. It kind of stayed down the rest of the day, kind of moved around a little bit, but didn't move just a whole lot. They even, kind of tried to pop things back up into the afternoon, but that didn't work out too well. It just kind of stabilized, and really kind of a quiet day compared to what we have normally seen. And of course, we get into our afternoon markets, and by the time we get to the afternoon, the whole world is shut down except the Americas. You have North, Central, South America open and trading. We go into 4:15, and again, that is Central Time, even though the cash markets on the East Coast close out at 4 o'clock. 5:15 in the afternoon, literally about an hour and a half ago, we will close out our official day. The equities close out at 3 p.m. Central Time. The futures close out at 4:15, and then we take a big breather of a whacking 45 minutes, and we start all over again. So like I said, it's virtually a 24-hour market. So we do have to figure out when we're going to sleep and eat and spend time with the family. So this is kind of a picture, if you will, where we kind of start here and kind of work our way around the world. Start out at 5 p.m. up until 3 a.m., 3:30. From 3:30 to 8:30, we have Europe. We come into our morning U.S. market here. We go chow down, eat a little lunch, fill up our little bellies, and we come back in the afternoon, and we kind of round out our 24-hour day. And if you think about time, we are the last market to open, the last market to close around the world. So in time, we are not the forefront of the market. We are at the bottom of the totem pole in the line. So a lot of times we follow what the world has done. But there are a lot of times that we lead also. There are times that we will have a big rally in our day or a big decline in our day, and Asia is going to start out a whole lot higher or a whole lot lower. So one thing that you will find that we start looking at are opens, which we get into key numbers. You hear a lot of people talk about closes. I don't know why. I never have figured that out. I mean, I used to run track when I was in high school and college, and I have never been able to start the race at the end. I don't know about you all. Maybe you all have. I have not been able to. So, and you don't buy a ticket to a football game to get there right at the end of the game. That's no fun. So we always have to start out at the beginning. We have to start out at the beginning of the race. So the beginning of our race each and every day is the open. One thing that does is kind of eliminate, I'll call it the noise of the market, if you will. If we had a big rally here, I know that the Asian markets are going to start out higher, but that doesn't mean they go higher the rest of the day. They might sell off from their open and pull back and pull back and pull back as the market corrects a little bit, and they end up down for their day. Well, they might still end up above their previous day's close, so you'll hear the market gurus out there say, well, no, the Asian markets were up. But if you looked at it from their open, they might be down. So we always do things based off of open. we start trying to figure out support, pivot, and resistance. I think everybody's doing that. I mean, there's not anybody out there that doesn't look at some price somewhere to say, hey, here's support, hey, here's resistance. Where did it bounce off of? Where did it hit its head on and pull back from? Everybody's trying to figure out where that support and resistance is, because if it gets there again, who's to say it's going to break through this time? And if it does, well, they're going to start running stops, right? And all of a sudden it's going to start moving a whole lot more. The thing is when we start looking at support and resistance, the biggest number you can have, in my opinion, is pivot. This is not calculated. This is what the market gives us. And if you think about this very quickly, what's the best number for pivot? Open. Because think about it. If you're above open, who's winning? Bulls. If you're below open, who's winning? Bears. So why not use the open for pivot? Now, we have to figure out which open, right? Because if I'm a long-term trader, I might be looking at week and month, oh heck, whatever, the year open. I got an investment portfolio. I might just be gauging things from the year open every year. As long as we finish above last year's open, hey, I'm looking pretty good here. And if you've been doing that for the past 5 or 6 years, you have been doing pretty well, right? So, but if you were looking at something, a little shorter term, swing trading, maybe an intermediate time trade, we can start looking at monthly opens or weekly opens or daily opens. If you're a day trader, use the day and, every 30-minute bars open. So we can start looking at these different opens depending on what kind of a trader we are. If you want to look at it kind of like a funnel, if you will, we can start with the year and go to the month and go to the week and start going from there. But these opens will give us a point at which, as long as we stay above it, we're bullish. If we're below it, we're bearish. If you look at some of the major market indicators here, it depends on really the time of day, as I was stating earlier. At night, we use the Asian and the European cash markets. If their cash markets are moving higher or their cash markets are moving lower, and you can, if your software tracks this, great. If not, go to Yahoo Finance. You can look at the Asian and European markets from there, or even barchart.com or something like that. But you can kind of get a feel for what those markets are doing. And they'll always give you where it opened, where it's last traded, and then it'll give you the change. But that changes from the previous day's close, so watch out for that. And a lot of people get confused. Well, how can we be below open, but we're the percent change is positive? It shouldn't be. Well, that's just because they gapped up or they gapped down based off those cash indexes. Just because they shut them down and they had to wait 16, 17 hours, and then they opened back up again. So, but during the day, we have a whole lot more indicators, right? We have our New York Stock Exchange tick. We have our advanced decline line. We have our index futures that have been trading for 24 hours. And if you think about the advanced decline line, everything is performing based off of the previous day's close. The tick is a cash. It's almost instantaneous. It's looking at price action only. When you see the tick at plus 500, that means there are 500 more stocks that ticked up in price than down in price since the last time they checked it out. That's literally what it is. And that might be for every second or every 5 seconds or whatever it is. So it's a very, very, very quick indicator. But the advancers and decliners are kind of a longer term. It's kind of like the oil tanker that you're trying to turn around. And you can't quite get it to turn around. It just takes a longer time for it to turn, just because everything's based off the previous day's close. So I got a longer term indicator in the equities and then a shorter term in the equities. And of course we do watch the equities. Why? Well, because there's what in the indexes, and the only way for an index to move higher is for the equities to move higher, and the only way for an index to move lower for the equities to move lower. And the index futures, well, if they're a derivative of the cash index, well, it's the same thing. If equities are pushing higher, then odds are in the future things will be higher, right? So we do watch the equities just to get a feel for what everything else is going to be doing. So when we start looking at it, you have to kind of start figuring out how do you determine the flow of the market. I mean, think about it. Everybody's trying to figure out where to enter, where to take profit, and if they're any good, where they're going to put their protective stop, or where's their risk, if you want to look at it that way. And there's a lot of ways to limit risk. I mean, options are one of the best tools out there for limiting risk. You can buy a stock, you can sell covered calls, flip around and buy a put. And the call that you sold finances the put that you bought. If it goes down, the put pays you. Of course, what you're in, whatever stock or futures contract you're in, doesn't pay you. But you can make up for that with the put that you got, the cash that you brought in off of the call that you sold, and all of a sudden you might be able to get stopped out and not lose a dime. just because of the options. So there's a lot of different ways of limiting risk. So, but when we start looking at things, one way of limiting risk is what? Well, stay with the trend of the market. So, are we above the year open? Are we above the month open? Are we above the week open? What about the day open? Where are we trading right now based off of those opens? And if they're all pointing in the same direction, then that's the direction that we need to be looking to trade. Now, when we have an uptrending market, you're going to have down days. I mean, nothing tickles me more, I say tickles me, amazes me more, maybe is the best way of putting it, that people don't like to see a down market because their 401ks and their IRAs and things like that go down when the market goes down. So you might see the S&P sell off in a day 15 points. You might see the Dow drop 110 points in a day. The NASDAQ dumps off 37 points in a day. And everybody goes, oh man, the market just dumped off today, blah, 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 blah. But what's really funny is if the market's up 110 points in a day in the Dow and up 37 points in the day in the NASDAQ and up 15 points in the S&P, we had an up day, right? Well, just to let you know, the average range of the S&P in a day is about 15 points. The average range in the Dow in a day is about 110 points. So if you have an average up day or an average down day, you just had an average day. But most people react differently to up days and down days. So you might have an up day or a down day. You might have an up week or a down week in an up market. So when we have a big, long bull market, I mean, think about how everybody was reacting at the beginning of October. You actually had an exactly in the S&P a 10% decline to the tick, virtually. And then it turned back around. It took 4 weeks to sell it off, and it took 2 weeks to get it right back to where it was when it sold off. I mean, it was incredible. But that's the thing. We're going to have downturns in up markets. We're going to have upturns in down markets. So we can use these opens to kind of keep us on the right side. If you look at this year, we started out the year, there we go. We started out the year, that 36 is backwards. That's supposed to be 63. See, typo. But we started out the year at 1837.75. We started out this month. We started the month this week, right? So at 2063 quarter. That's supposed to be 2063 quarter also. I typed in 36, little typo. But we started the week out at 2063 quarter just because it's the same as the month open. Currently, we're trading at 2072. So we're about 9 points above the month/week open, but we are, 240 points basically above the year open. We've had an up year, and unless the S&P sells off 200 points in the next 26 days, 25 days, whatever it is, we're going to end up this year. So if you had stock from last year, we're going to be looking pretty good. But we are above all of those opens. If you look at where we started out, our new 24-hour market, remember we started out at 5 o'clock, we started out at 2071.75 in the S&P. Right now we're trading at that price, 2071.75. The Dow is actually up about 3 points right now, so which isn't much in the Dow, but still, they're being a little more positive than negative, or neutral, if you will. So, like I was saying, in bull markets, markets move slower. I mean, think about it. If you go back to the 2008-2009 time period, right, we sold off quite a bit. We started out at around 1587 in the S&P. We went down to 666 there. And all of a sudden, we turned back around and we started rallying in 2009. We've been rallying since 2009. Actually, it was March of 2009 when we started the rally, and we're still going up, making new all-time highs. We made a new all-time high today in the S&P. So we're making new all-time highs, not every day, but at least once a week. Not really on, I guess on average, I don't know. I mean, when you make new all-time high 3 or 4 times this week, and then next week, I guess you've got it for at least 3 weeks there. But in bear markets move very quickly. We had a year and a half down, or a year down, and we've had 6 years of up. just about. So we have bull markets that move up slowly. We have bear markets that go down quickly. You'll find most futures traders like markets that sell off because they pay you so well to the downside because they move a lot. To the upside, it takes a long time to get paid going up to the long side. Stocks have a tendency to do better. Unless you have a cast iron stomach and can hold on to something for a longer period of time. So, but nothing ever goes straight up or straight down. So we do have to kind of look at where those waves are going. Now, if we start looking at, and this is kind of our seasonalities, looking at the holiday markets here, November through January, based off the past 50 years, the S&P on average is up about 4.4%. The Dow virtually the same, about 4.3%. That's the beginning of November to the end of January. But that doesn't necessarily tell you how the market got up 4.4% or the Dow was up 4.3%, because nothing ever just slowly just goes up and up and up and up, and you have an up day every day. You have up days and you have down days. On average, the S&P and the Dow are up 1.7% in December. So a lot of the move happened outside of December, right? If you're looking at 4.4%, well, you've got some movement in November and maybe some movement in January or something like that. But when we start looking at the seasonalities of things and kind of picking this little area up or apart, the market is up in November through the middle of December, usually. Okay. About the middle of December, to the end of the year, we're usually flat to down. And if you think about that, just a little bit of logic here, everybody likes to get out of their bad trades at the end of the year, right? Well, they want to write them off on their taxes. If I can get that $3,000 write-off, or if you're a trader or something like that, and you can take the whole loss, they're going to get out of all of their losses toward the end of the year. Not only that, but these big fund manager guys, don't want to be looking bad, so they'll get out of all their losers and start just jumping into all the ones that have been going up this year, and at the end of the year they can say, look, we had all the stocks that went up. So they call that window dressing, right? So, but usually in December, starting about the middle of the month, which is usually when people start going on vacation or doing their Christmas shopping and getting ready for the holidays, the market has the tendency to kind of flatten out a little bit. Once it kind of flattens out a little bit, it has a tendency to start kind of moving down a little bit. Not much, but it kind of gets chewy. The first 2 weeks of January are kind of choppy. Everybody's trying to figure out what the year is going to do. And then the last 2 weeks, the market has a tendency to trend. So really your bull market, your best bull market during this time is to get long somewhere around the end of October, hold it to the middle of December, and then go on vacation for a couple of weeks. Come back in January and see what it does during the first couple of weeks. If it's looking a bit weak, odds are it's going to be down. And that's the one thing you have to start looking for. How do these things typically get there? Even though they might be up 4.4%, most of the move is probably done in the November time period up. You have a little more up in December, and then January is kind of a flip of a coin. Sometimes it's up pretty well. Sometimes it can be down. This is this year, actually last year, because we don't have January and stuff like that this year. But look at this. We're starting out, beginning of November. This is 2013 into 2014, just to kind of give you this little pattern. So here's our little rally coming into the November. This is actually a daily chart of the S&P futures. But we had this nice little rally coming up into December. We started kind of chewing around here. Notice a little correction here about the middle. And then actually at the very end of the year, at the beginning of this year, at the end of last year, they started to kind of push up a little bit. And then they kind of flattened out. They were trying to figure out, do we go up, do we go up, do we go up? Now remember what I told you earlier. We opened the year at 1837.75. So we opened up in here somewhere, and we went up to 46.50. They couldn't get above 46.50. There's your resistance, right? And all of a sudden, they were just like, and then they dumped off. And at the beginning of February, we hit our lows down at 1732. Kind of dumped things off, and of course from there, what they do? Flip back around and they started rallying it, right? And so we haven't been back down to 1732 since then. We've had an up market since that time. And that's the one thing we want to start looking at, is we can stay with the bull here going into January, but once we get to January, it's time to start to be cautious. I have a tendency to stay out of the market in January. Why? Because, well, sometimes it's up, sometimes it's down. And think about your little general rules of thumb. You know, if you're long in the market here, you stay long into the end of the year. Then you got to be cautious. Your most bullish days in December are just before and really just after Christmas. If you want to look at your up 1.7%, if you start getting long, I don't know, somewhere around the 21st, 22nd or so, those couple of days coming into Christmas, up into Christmas Eve, usually pop up, Christmas cheer. And just after Christmas, they have a tendency to move up a little more, on the 26th, 27th, so on and so forth. Then after that's when they kind of start, waving a little bit, maybe it's selling off a little bit. Sometimes you have a nice little rally. But by the second week in January, I look at being out. Let January finish out. You can always get back in February. But when we start looking at the first quarter, and this is actually of 2015, since, well, we're already past 2014. The first quarter is best for observation overall. You can have some ups and some downs. If you kind of look at the first quarter a lot of times will set a low in the market. If you go back into the 2001 up through 2010 time period, you had 7 of those 10 years that the S&P actually made a low in March. If you'll notice, in 2009, we made the low in March, right? Of 4 of those years, you had another low made in the summertime, July, August. So we have a weak time period in Q1. We'll usually have a weak time period in the third quarter of the year. The fourth quarter of the year usually is a little stronger, except for the first 2 weeks of October, where the first 2 weeks of October can usually be kind of nasty. We want to stay away from rules of thumb. And what I mean by that is this. They always say, up first week of January leads to an up first month. Up first month leads to an up first quarter. Up first quarter leads to an up year. That's bogus. There's been a lot of years that we've had a down first quarter, and, well, we've been up on the year. Look at 2009. We had a huge rally off of the lows in the first quarter. You had a down January, you had a down quarter, you had down, 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 yet we ended up, up. Rules of thumb can hurt you. When in May, go away. How'd that work this past May? If you got out in May, you lost a lot of money. Actually, you didn't lose a lot of money. You missed out on a lot of money because we took off and rallied going up into August. So the rules of thumb don't have a tendency to work too well. Remember back in 2000, we had a down year. We had another down year actually in 01 and 02. And they said, well, we'll never have another down year because the S&P's never had 3 down years. Guess what? They did. Had a third down year. So their little rules of thumb aren't working too well. Why is that? Well, the markets have changed. I mean, think about it. You go back 20 years and, well, what is the internet? It was just coming out. They were just getting into a little bit of electronic trading here and there. So everything was done by the phone. People went on vacation. They didn't take their iPads and their cell phones with them. They just went on vacation. Nowadays, you can go on vacation, be on the beach, and check what the market's doing. As long as you got internet access or 4G network access, right? You can do whatever you want to do, whether you're on vacation or not. So people take the market with them anymore. They can still visit their family while being on vacation, where before it was just your immediate family with you. You can be with your friends. You put it up on Facebook. So the electronic age has changed things quite a bit. And it's actually changed trading quite a bit. You don't have you didn't have very volatile markets way back when, unless you had huge news. And, well, now you have some pretty volatile markets. If you look at the S&P and the Dow, the S&P actually got to an average range back in October, an average range of somewhere around 30 points in a day. 35 points in a day, which is twice its average range right now. The Dow is moving around to about 250 points in a day. Now they've compressed back down because things have gotten a little more normalized, if you will. So when we start looking at these seasonalities of things, we can start taking advantage of these moves. One of the best trading weeks of the year really is between Christmas and New Year's, just because the markets are kind of slow. You don't have a whole lot of risk. They can trend down, they can trend up. It really doesn't matter, but we can take advantage of those trends, and we don't have to be real fast. We could actually get into a trade, hold on to it for 3 or 4 or 5 days, maybe use options, something like that. But there are a lot of things that we can do during the holiday markets to take advantage of these moves. Once we get into the first quarter of next year, or even the second quarter, you're going to have some times that are better to trade or not so good times to trade. So when we start looking at how the markets begin to move around, between November and really May. If you go November to May, it's probably the best time to be in the market. And that's why I like to trade a lot of commodities, because during the summer months, the markets might be kind of chewing around. This past summer they weren't, right? But a lot of times they will. But if you're trading corn or wheat or crude oil or something like that, you can take advantage of some really, really nice moves just because they have harvests, right? And usually you'll have a lot of moves because of the harvest and what they're expecting from harvest. And of course, crude oil, it has a tendency to go up in the summertime. This year it didn't do that, but it has a tendency to move around quite a bit in the summertime just because of the demand on gasoline. And of course, gasoline moves around a lot, but you can take advantage of those. If you go to the grocery store, look at the price of beef. Why is the price of beef so high? Well, you had some pretty nasty little droughts out there in the Texas, New Mexico, Arizona area. Lots of cattle ranches out there a couple of years ago, and either you let your cows die, you tried to get some water or hay to them somehow because you couldn't grow any because of the drought, or you sell them off, so they sold them off. Well, now they're trying to rebuild their herds, so they're not putting any in the feedlots. So you've seen the price of beef move up a whole lot higher just because of the lack of beef that's out there. My guess that will go through this next year. We'll probably have higher beef prices next year as well. But after that, then we might have a nice herd again. They start bringing the price of beef back down. So we might have to withstand this for a little while longer. But to make up for that, price of gas is pretty low. And that's the thing. We can start looking at these seasonalities of these different, not just futures themselves, but you can trade stocks based off of those things. They have the ETFs. You can do options on the ETFs if you don't have the money to buy the ETFs. But we can take advantage of these, not only holiday trading, but there are holidays throughout the whole year. We can look at different holidays, and we can start taking advantage of tax day. We have buy some Hershey going into good old Valentine's Day and Easter. Hershey has a tendency to go up just because of the demand of chocolate, right? So, but we can use these little seasonalities in these different places to really take advantage of some of the moves in some of these various markets. The second quarter, as I was just kind of going through the quarters here, is the only quarter that we've had that doesn't have a new year low in the past 10 years. So it kind of tells you something. You can have a new year low in the first quarter. You can have a new year low in the third quarter. And, of course, this year we proved that we can have one in the fourth quarter, too, which was in October. But it wasn't really a year low. But we did have a pretty substantial little sell-off. So we can have some weakness early, especially in Q4, but it usually is strong going into the end of the year. The third quarter, which is the summer months, is usually strong early and kind of weak late. Then you get kind of a bounce, if you will, in September, and which is at the end of that quarter, and then all of a sudden we hit October and it corrects back down again, then you start having this rally. So just noticing the, I hate to use the word normal in the market, but you do. Just to use the word normal, in a normal year, this is kind of how things will have a tendency to go. Of course, again, beware of the rule of thumbs. It doesn't happen like this all the time, and we have different newses throughout the year. Think about when some of the European countries were having problems with their sovereignties and staying liquid and stuff like this. Man, that was driving the market nuts. But then you get rid of that stuff, and what do you get into? You have wars going on, or arguments, or whatever you want to call them. And so people spat and everything like this. They have different trade agreements. You have, different weather conditions around the world. I mean, there's a lot of different things that happen from year to year to year. And if you think back, even crude oil right now, you have an argument going on. It's a geopolitical war between OPEC and the shale oil guys. Who can outdo who? OPEC wants to put them out of business, and the shale oil guys want to keep pumping oil and make lots of money, right? So they're kind of battling it out right now, and who can put who out of business or take power from who. OPEC wants to still control the oil market. They have for years and years and years, and so they still want that power. So they're trying to drive down the price of oil to put those guys out of business, because crude oil needs to be somewhere around 70, 75 bucks a barrel for them to cash flow in the shale oil business. Below that, they're kind of hurting a little bit. So, that's the thing. But we can kind of go from quarter to quarter on a bigger picture here and kind of get the natural tendency of what the market can do. And when we start looking at these natural tendencies, we can start looking at trading in those same directions. We start looking at, well, if we make a low in March, odds are they're going to bounce off that and have a nice rally going into the June, July time period. Well, why not take advantage of that? And there's a lot of different ways of doing it. Whether you're trading stocks or whether you're trading options, whether you're trading futures, it really doesn't matter. So we can use these different quarters, if you will, different times of year, to take advantage of longer term moves. It used to be you buy a stock, hold on to it 30 years, and you make money. It's really hard to do that anymore. We've had, some big market move down. You think about us when we got down to about 700, 900 back in 2001, 2002, had this huge rally back up, went up 100% in the S&P. Then they dump it back off and take out the 2001, 2002 lows. We went down to 666. And now here we are, literally a good not 2,000 points, but a good 1,500 points higher in the S&P. So we do have these big corrective moves. And if you think about this is kind of interesting. If you go back and look at the whole history of the U.S. markets, we have never gone more than 10 years without having a recession sometime. And so here we have been going for 5 or 6 years. Odds say in the next 2 or 3 years, 4 years, we're going to have a corrective recession. It's just what's happened in all of history. Now, does it happen this time? I don't know. But that's what the odds say. So here in 2018, 2019, might be getting just a little bit worried about seeing what's going on. Of course, we're going to have different economic conditions then. But this has been the slowest recovery forever, so this one might take longer, right? So we do have to kind of watch for those. When we start looking at, and I have no idea where all my little verbiage went. It has disappeared. There it goes. When we start looking at trading in holiday markets, I only have like 5 minutes here, so I'm going to run through this very quickly. There's a picture of Tom. We actually have a little class. If you want to attend, a little 2-hour class. It's on Thursday, December 18th, from 10 to 12 Central Time. It's in the morning. We've done these in the evening. We do some in the late mornings during the day, just so we can get everybody in there. But we're going to start looking on how to trade futures and stocks now, going into the end of the year. We want to know what we can buy, what we can sell, what's the best thing to buy, what's the best thing to sell. Option strategies. A lot of people trade options, love options to death, going into the end of the year and, of course, beyond. Do you go out and start buying the 2016 leaps to take advantage of next year? Is next year going to be bullish or bearish? What should be the tendency of what's happening next year? We can start starting to figure that out. But we can maximize our trading inside of our 24-hour market. You can time your equity or your entries and exits. You can do this based off the seasonality of all the markets. And it's really kind of a cool way to see if we can start taking advantage not only of the seasonality of this time of year, but we're going to start looking at seasonality through the rest of next year. So we can see if they start holding to those little probabilities. As a bonus, if you do want to attend, you can get 2 recordings. This is basically on demand. Intro to futures, stocks, and options if you're kind of new to this. And of course a professional trader's guide to your 401k, how to manage your 401k. I notice a lot of people out there have 401ks. They don't know how to manage their 401ks. It's probably one of the easiest things to manage. The problem is I mean, it's kind of a big, huge irony. People want more money, but they want somebody else to manage it. You're the best manager of your money. So why not take advantage of this? And this little guide here will show you exactly how to manage your 401k. It's very, very simple to do. It's about a 45-minute little video, something like that, but it's really pretty cool. And of course, this includes the recording of this live event, of course, and those 2 bonus recordings. If you're interested in doing this for $97, come join us on December 18th. You can use that little link right there, dtitrader.com/market. You can go there and sign up. And we will be more than happy to help you out in looking at the next year. We always plan out our trades. We plan out our weeks. We plan out our months. We plan out our years. But for 2 hours, come join us. We'll have a lot of fun and learn a little bit about the markets. If you have any questions, and I assume I clicked the little plus button next to questions, I'm going to make that assumption. And try to move things around a little bit so I can scroll. How do you to define support and resistance? Well, think about this very quickly. I don't know when that little question came in, but think about this. If a market goes up, makes a high, and pulls back, well, it's got to be resistance, right? Because sellers stepped in and pushed it down. So if you have a low, same thing. Buyers step in and push things higher. But it all depends on your trade horizon. And what I mean by that is how long you're looking to be in a trade. Before you would get into any trade, we needed to figure out, hey, I want to buy this stock, and I think it's going to be up through May, there. Or I'm going to buy this stock, and I think it'll be up through, the end of the year. 2 different trades. So we're going to be looking at different supports and resistance. The longer you hold something initially, the greater the risk you have. Just because you have to give it more room to play around if you're looking for it to hold on to it for a long period of time. The shorter the time period that you're looking to be in a trade, the less risk you can have. So we have to start stepping back and looking at what our trade horizon is. Sometimes if you're looking at to buy a stock, you might have to risk $15-20 to be in it. Just because that's where it came from. I mean, look at our current markets. These markets have moved a lot. Even the $80, $90, $100 stocks, which most stocks are between $50 and $100. So, but a lot of those, $70, $80, $90 stocks, they have moved, up $10 over the past, 2-3 months. So all of a sudden, I'm going to have to risk $10 to be in it if I want to be in it for a long period of time. But if I'm looking to see if this thing can move from 90 to 92.5, I might not have to risk that much. I might have to risk, $1 or $2 or something like that. It might be easier to trade it with options. But that's the thing. We will have to kind of determine that. We'll go through a lot of that in this class, definitely. So, but just to, I know I'm kind of running out of time here, and start going from there. But again, if you do want to, wrong way, there we go, join us, again, go to that www.dtitrader.com/market, and for $97 you can join us for a couple hours, and we will pick apart the markets and have a good time. I'll probably be in there the first hour or 2. Tom will probably be in there the last hour, maybe an hour and a half or something like that, whatever it is. Tom usually kind of finishes things up. But we can give you both of our insights into what the market's going to be doing in the future. So I guess my time is up, but thank you all for having me. Hopefully you learn a little something, and look forward to seeing you in the future.